Welcome back. In today's session, we'll be focusing on Unit 3 revision, which we are going to discuss about equity and debt capital in furtherance of the Companies Act number 7 of 2007, which we started to discuss under Unit 1, where we discussed about the features of a company, how the company features have been differed since the previous Companies Act into the new Companies Act. And then under Unit 2, we discussed about the different types of companies and the incorporation procedure and process of a company. And today we'll be starting to discuss on the equity and debt capital of a company, that is how a company is being financed. So this is a short note once again. The explanations that you ought to know for the examination will be discussed as well as given to you in the note. So first and foremost, we have to discuss what is capital. We have to start by discussing what is capital. So the term capital refers to any financial resources or assets owned by a company that are useful in furthering development and generating income. Simply what we call as capital of a company are the financial resources that a company has. Are the financial resources of a company can be in the form of assets or any other different types of capital which are important for the development of the company and to generate further income. Capital is used in general to generate income for the company. Capital can refer to funds raised to support a particular business or project. So capital is also the money that we are using to raise or support a business. Capital can also represent the accumulated wealth of a business represented by its assets less liabilities. So simply, your capital is the wealth of the business, or what does the business have. Even if you take human beings also have their capital. How much of a wealth do we have? Same way when it comes to a company, the meaning of capital in a company is the wealth that the company has, which is represented by the assets minus liabilities. So easiest way to represent this is assets minus liabilities. The assets minus liabilities is this is a very simple definition for capital. Capital can also mean stocks or ownership of the company, because there's one particular type of capital called equity capital. So equity capital, later we are going to discuss furtherance of the equity capital also. So meaning of equity capital is that it is the stocks or ownership of the company. Capital may be raised either in the form of equity or debt. So this is usually in the form of an investment where people invest, or this can also be in the form of debt capital. Capital can be in the form of debt capital where the company issues loans. The company takes loans from outsiders. Company takes loans from outsiders. That is called debt capital. So capital is of two types: equity capital or debt capital. Equity is what shareholders invest in the company and forms its basic asset base. So equity is the basic asset base of a company where shareholders invest in the company. By purchasing shares, shareholders invest in the company. The company does not have to repay equity to shareholders, or in other words, shareholders don't have a right to ask for the money that they invested. So simply said, when it's an investment, it can be a profit or a loss. Of course, we invest thinking that we will have a profit, but investment can carry a profit or a loss. So therefore, when a person invests in the equity capital of a company, it can end up being a profit or a loss. So shareholders can't ask back for the money that they invested. Of course, if the company will, at the moment of liquidation of the company or closing down of the company will pay their company will pay back the money that they invested in the company, but it is not a must. But on the other hand, when you take debt capital, if company takes debt from somewhere, company is supposed to pay it back. Company has to pay it back. Debt, on the other hand, refers to funds borrowed by the company. So basically, it's a borrowing. Debt capital is a borrowing for the company, and therefore it has to be paid back. It has to be paid back and has to be repaid. So that is the main difference between equity capital and debt capital. We'll be taking one by one separately and discussing just to get a further idea. So when it comes to a company, another important test is this solvency test. Now, before moving on to companies, let's try to understand what is a solvency test. Even for us human beings, meaning is, now usually when you are expending your money or when you're spending your money, you have to always think about how much money that you are getting. So if your expenses are more than your income, that means you are heading towards insolvency, or for human beings we call it bankruptcy. You are heading towards bankruptcy. So when a company heads towards bankruptcy, it's said that the company is insolvent. We say that the company is insolvent. If the company is heading towards bankruptcy, we say that the company is insolvent. So from time to time, for different aspects, later again we are going to discuss about the solvency test, where the solvency test comes into being, or where do we particularly do a solvency test. So for companies also, from time to time we have to check if the company is solvent or insolvent, meaning whether the company is able to pay its debts or whether the company is unable to pay its debts. So that is what we call as a solvency test. We expect organizations to be solvent. We expect organizations to be solvent, that is, they are able to pay their debts. Now, what do we check? What are the criterion that we check in checking the solvency test? A company shall be deemed to have satisfied the solvency test if it is able to pay its debts as they become due in the normal course of business. So in the normal course of business, if they are taking debt, they should be able to repay them. So first thing we check under the solvency test is the ability to repay loans. Ability to repay loans. In the normal course of the business, you should be able to pay the loans that you take. Ability to repay the loans. Second one, value of the company's assets should be greater than the value of its liabilities plus the stated capital. So the second requirement that we check is the assets of the company, value of the assets of the company should be greater than, value of the assets of the company should be greater than their liabilities plus stated capital. Liabilities plus stated capital of the company. If these two have been fulfilled only, we say that the company has passed the solvency test. First thing is, in the ordinary course of business, company should be able to pay its bills. Second thing is, the assets of the company, value of the assets of the company should be greater than the value of the liabilities and the value of the stated capital of the company. That is the basic, the remainder of the equity of the company, the stated capital of the company. In determining whether a company satisfies the solvency test, now for these, to check whether the company is able to pay its loans, to check whether the company's value of the assets is greater than the value of the liabilities plus the stated capital, you need to have the accounts, or you need to have values, you need to have the numbers, right? So from where does the directors get these numbers, right? Shall take into account the most recent financial statements of the company prepared in accordance with section 151 of the Act. You don't have to remember the section number. You have to check the recent relevant financial statements. To check the values for these, you check the recent relevant financial statements. Shall take into account circumstances the directors know or ought to know which affect the value of the company's assets and liabilities. So other factors that the director should know, either the director knows or the director should know, right? That will have an impact on the values of the assets and liabilities of the company. May take into account a fair valuation or other method of assessing the value of assets and liabilities. So usually you do a fair valuation method. Usually the methodology used is called a fair valuation method. So a fair valuation method is used to check the assets and liabilities. So again, let's try to, study it together with me. To check whether a company is solvent, we have to check two things under the solvency test. First thing, we have to check whether the company is able to pay its debts in the ordinary course of business. Second thing is whether the company's value of the assets is greater than the value of its liabilities plus stated capital. So, what are the things that the company will take into consideration when ascertaining these two factors of the solvency test? First thing, the company will check the recent relevant financial statements. The recent relevant financial statements have to be checked. If it's audited financial statements, rather better. Second one, the factors that the directors should have known. Should directors know, or directors should have known about the values of the assets and liabilities of the company. Third factor that the directors will usually consider is a fair valuation of the assets liabilities of the company. So those are the things you need to know about the solvency test. In what situations do we use the solvency test? We'll come to that later. Right? Our next question is, why is capital management important, or why do we need to know about the capital? What is the impact that capital will have in the company. One of the most important things that determine whether the company will succeed in its ability to access capital when necessary. So basically, we should be able to know whether the company will survive. I won't call it thrive, whether the company will survive. Just merely surviving is sufficient without closing down. So to survive, whether the company is able to survive in the long run. One of the main ways of checking whether the company is able to survive in the long run is by checking the capital, whether the company is able to ascertain its capital. All businesses require capital in order to purchase assets and maintain their operations. So without having assets, they will not be able to maintain the operations. Therefore, capital is important. Capital is necessary for the growth, maintenance of any business, and repayment of its debts when the need arises. So, without capital, simply without capital, organization cannot survive. An organization should be able to, at any given time, to ascertain the going capital of the company, or how much of a capital that the company has at that particular moment. Company should be able to recognize. Right. Next one, we are moving on to different types of capital a company can bring into business. Right. What are the different types of capital that a company can bring into business? We are still under the capital lesson itself. As I told you, it can be either equity capital or debt capital. Let's see what are the differences. Equity capital is the money raised by a business in exchange of share ownership in the company. So basically, by investing in equity capital, what will the shareholders get? They are getting ownership. Shareholders are getting ownership for the amount that they have invested in the company. They will have voting rights, and therefore shareholders are given a part of the ownership. Equity financing allows a business to obtain funds without incurring debt and without having the burden of associated interest, principal payment. So the main advantage, or why would a company like equity capital, is because when you take equity capital, company don't have to, think about the repayment aspect. Company don't have to think about the interest payments like in debt capital. Right? So therefore, companies like equity capital with regard to that aspect, because you can obtain funds without really incurring a debt, without increasing debt in the company. You can, by selling the ownership of the company, you can get more and more people to invest in the company. Thereby, when people invest in the company, company's capital is raised. And you don't have to think about the repayment issues, because it's not a must that the company have to repay the share capital or the invested capital. Second thing is, there are no interest payments. Of course, one might say shareholders have to be paid a dividend. A dividend does not come as of a right, especially when you take ordinary shares. Later we are going to discuss. Dividend does not come as of a right. So therefore, only if the company has distributable profit, that the company will have to pay the dividend. If the company don't have a distributable profit, or even if the company is making losses, then company don't have to pay a dividend. So those are the good things about equity capital. Anyway, there are both advantages and disadvantages of equity capital too. So one by one, we are going to discuss the advantages and the disadvantages. First, we'll discuss the advantages of the equity capital as well as the disadvantages, and we'll be discussing the same for debt capital as well. Now, this is a questionable area. If you do a past paper analysis, they have asked what are the good things about having equity capital in a company, what are the bad things about having debt capital in a company. You should know the pluses and the minuses, pros and the cons of these type of capital. So let's see what are the advantages of equity capital. Lack of recurring principal interest payments. Lack of recurring principal or interest payments. You don't have to think about, like the interest payments, how now even if we have profit or not. Now, if you take a debt, if you take a loan, whether you have a profit or not in the business, you have to repay the debt. You have to repay the loan. That is particularly not important when it comes to equity capital, because only if you have profit, you will pay the dividend as part of the profit. So it particularly does not affect the company. Second one, corporation's risk is shared with the investors. So otherwise, if I am the sole owner, if I am the sole proprietary shareholder, only person who is the shareholder of the company, if the company undergoes losses, it will greatly affect me. because it's entirely my money that is in the business. Now here I am not completely, investing my money. I am taking money of the other shareholders as well. So therefore the risk is also shared between several shareholders. The correct investors can add significant value. Shareholders can take part in the decision making of the company. Of course, not the day-to-day decision making, but in the strategic decision making of the company. So if you have a well-educated, well-qualified, well-experienced shareholder, that person in itself is an asset, because that person will be taking good decisions on behalf of the company. So therefore, if you have proper good shareholders, it's in a sense another asset of the company. Smooth transition option for business owners looking to ease out of the business. So especially, let's say I start a company, right? I have my shares. I'm the majority shareholder first, and little by little I am selling shares of the company to outsiders. Now I can completely get away with my liability, sell all the shares that I have, and go on to start a new company if I want. So it's an easy way to, ease out of a particular business operation as well. Maybe the only possible type of capital for rapidly growing an asset-light company. So sometimes, let's say you want to start a business which requires a lot of capital, but you yourself don't have the money to start that sort of a company. No problem. You can issue your shares to the public, or if you're starting a public limited company, or at least get a few of your friends, family members. As a private limited company, you can, even if you don't have money, you can raise capital with your shareholders. By taking the money of your shareholders, you can raise the capital. Equity investor is committed to the company until his or her exit. If the company gets into trouble, the equity investor is like to help with the turnaround. Right? So that's another one. Equity investor is actually committed to the business. Now, shareholder knows only if the business do good, I will be paid. Now, when you take a bank loan, right, whether you do good or not in life, irrelevant, because bank loan have to be paid, right? But if you do good or not in your life, your parents are bothered, right? But any day, how you look after them or whatever it is dependent on how you survive in life, how you thrive in life. But when you take a bank loan to get an exam done, bank is not bothered whether you will pass the exam or not. Yes, they know that their debt will be paid. So just like that, shareholders being the owners of the company, they'll be interested in the company. They'll be interested to know what is happening in the company. They will be interested in the survival of the company, which debt capital owners are not really bothered about. Because if the company gets into trouble, automatically the equity investor or the shareholder is also going to, will have to help out the company because otherwise it will affect the shareholder himself. But that does not mean that it's only advantages in equity capital. There are some disadvantages too. First one, owners are answerable to investors and some loss of control. Right? So owners in the sense, now usually when you take you can't say that owners are answerable to the investors. It's rather to say that, the directors, board of directors are also always answerable to the shareholders, and there is a separation between management and the ownership like we discussed in the previous two units. So thereby, the directors might find it very difficult, all the time. You have to give feedback, what is really happening in the company. Shareholders have a right to ask what is happening in the company. So all of those might be cumbersome processes. And also you are losing your control. Now let's say you started by having 100% of the shares with you. Right? Now little by little, first you go down to 80, 20 you have sold to someone else. Then you go down to 50, 30 you have given out to someone else. So little by little you can see you are losing the power or the control of the company. Earlier you could do anything you like because it is your company. But that, content is not there any longer. Now you have, sold your shares to other people. So you are losing the control over your company little by little. Can be more expensive than debt capital. Now that's another very important point, right? Usually issuing shares is more expensive, or making people buy shares is sometimes more expensive, or managing shares is more expensive than issuing debt. Because when you take shares, you can't just issue shares as and when you want. Today in the morning you wake up as a director or shareholder, decide we are going to issue shares tonight. You can't do that, right? Why? There's a procedure. You have to sometimes incur some legal expenses. So all of those are quite expensive, but that issue is not there when it comes to debt capital. It typically takes longer to raise equity capital than debt capital. Why? Debt capital, it completely depends on the ability of the company to repay their debt and whether people are willing to give a debt to the company. But shareholding is not like that. You have to keep the shares either in the share market or issue it to your friends, relatives, and wait till someone accepts the offer of the share, right? So therefore, raising equity capital takes time. Debt capital can be raised easier. Deal terms can be complex. With shares, just like you get some rights over the as a shareholder, there are also comes with some liabilities. So therefore, you have to fulfill your liabilities as well. It's not always about your rights. So therefore, sometimes the terms of issuing of shares might be a little complex to understand. Now, those are the advantages and the disadvantages of equity capital. Debt capital is where it's a borrowing for the company, but same as equity capital, there will be both advantages as well as disadvantages. Debt capital is money raised for a company that must be repaid over a period of time with interest. So you have to repay the debt capital, not just the debt capital, you have to pay the interest as well. Repayment plus interest. Not just the repayment, you have to pay the amount plus the interest as well. Debt financing can be either short term or long term. So usually when you're taking a debt, it can be a short term or long term debt. Sometimes even if you take a bank loan, there are overdraft, like small time overdraft facilities, as well as sometimes there are permanent overdraft facilities. Sometimes there are longer term loans. So therefore, debt financing can be either short term or long term. Unsecured debt is rare and lenders typically secure debt with the assets of the company. That's another problem with regard to debt capital. Now, even if you or me, we go to a bank, always you can, compare it with you can compare the legal person with the natural person and tend to understand a lot of things that are difficult to in general understand. Right? Now, even if you or me, we go to a bank, to get a loan. Bank don't just tell us, come, sit down, take the loan. No. We have to sometimes, show our assets. Why? They will give us the loan combined with the asset, or they will give us the loan on the asset. So if we don't pay the loan, they will sell the asset and recover their money. So just like that, here also when a company goes to get debt capital, unsecured creditors are very less. Usually people will give the loan or debt capital will be given or will be taken, company will be taken at the risk of their asset. That is, if the company is unable to pay the debt, they will lose their assets sometimes. Right? So the unsecured creditors are quite less. Usually they are secured creditors against the assets of the company. Now, what is the meaning of against the assets of the company? In case if the company don't pay or if the company is unable to pay with the ongoing capital that they will have to sell that asset and settle the debt of the outside creditor. That is what we call as secured against the assets of the company. Now, but there are advantages of debt capital, like I told you earlier, easier to raise. You can, less time is required. You don't have to pay a lot of legal charges and all like issuing shares. So there are good things, but there are some bad aspects of debt capital as well. Let's see what are the advantages of debt capital. Raising debt capital for profitable asset-intensive companies can be faster than raising equity capital. Main good thing about debt capital is that it's easy. You can easily raise debt capital compared to equity capital. Equity capital takes some time. Debt capital you can raise very easily. Debt capital is typically cheaper than equity capital because you don't have to incur legal charges, no big documentation required. So therefore, usually maintaining equity capital, or actually gaining equity capital, can be easier than gaining gaining debt capital can be easier than gaining equity capital. The lenders does not gain an ownership interest in the business, and this allows the business owner to remain in the driver's seat of the company without being answerable to investors. Now here in equity capital, main thing is we are losing our ownership. This one that I explained to you, we are losing our ownership. This problem is not there when it comes to debt capital, because our ownership is still there. Just because you go and take a bank loan from, for example, let's say you go and take a bank loan from a company for your wedding. Company can't tell you who you are going to marry. You are going to take a bank loan for your wedding. Bank can't tell you who you have to marry and who you will not marry. No, they will only issue the money for the wedding. Right? So just like that, in debt capital, they are not involved in your decision making or whatever it is. You will still be in the driving seat of your company. Right? That is another advantage, because then you have control over your company and your control is not diluted, or your ownership is not diluted just because you take debt capital. But there are some disadvantages connected with it as well. Let's see what are the disadvantages of debt capital. The loan amount and the interest payment can saddle the balance sheet and income statement of the company. As I told you before, you have to pay a dividend only if there is a profit. In equity, you have to pay a dividend only if you have a profit, right? But when it's a debt, whether you're making a profit or loss is irrelevant. Whether you're making a profit or loss, it's not our problem. But you have to pay your debt. It's a must that you have to pay your debt. So repayment, plus you have to pay the interest as well, whether you have a profit or not. Whether you have a profit or not, you have to pay both the repayment as well as the interest. Any downturn in the business or unexpected capital needs can make it difficult to make the interest payments and send the company into debt, inducing downward spiral, right? Sometimes, there can be capital intensive times for the company, or companies, times where the companies, capital wise not really doing good, or money wise company don't have cash at hand. In those situations, sometimes paying this interest aspect might be quite difficult. Paying this interest aspect might be quite difficult. But do you have an option? Can you, postpone payment? You can't do that, right? You will somehow have to pay that interest anyway. So therefore, it can even lead to closing down of the company. So trying to incur debt capital, sometimes you will have to close down your company altogether. For some debt instruments, the terms can be complex and may onerously burden the business. So sometimes these terms might be quite difficult. The debt capital terms, or just like equity capital terms, can be difficult to understand. Sometimes even debt capital terms sometimes can be difficult to understand. If the debt is personally guaranteed, liability will extend to non-business assets. Another very, very important one. Usually with a company comes limited liability, right? Basically, why people even start companies is because of the limited liability aspect. But sometimes for the company to get debts, for the company to get loans, right? Shareholders, directors will give a personal guarantee. Shareholders, directors sometimes tend to give a personal guarantee, right? Now, if you give a personal guarantee and if the company is unable to pay the debts, they can even get the money from your personal assets. Even your personal assets can be at a risk. So therefore, sometimes your limited liability status in the company as a shareholder or director also, you might sometimes lose. If the company gets into trouble, the debt financer could become adversarial. In case if the debt, if your person who have given you debt gets to know that the company is collapsing or that the company is not in good hands, they will ask for the money to be paid soon. Company will have to do something and pay back the financiers, especially the debts that they have taken, especially if it's a secured credit, especially if it's a secured debt. So then, earlier in the situation, if the company falls into trouble, shareholders help the company. But here, if the company falls into trouble, the debt capital holder, right, the person who gives the debt capital to the company will be adversarial. They will go behind the company asking for their money. So more and more issues to the company sometimes because of debt capital that can even result in the company completely collapsing or the company completely closing down. So you have to be very, very careful when you're either considering equity capital or debt capital, you have to balance between these advantages and disadvantages and decide what is best for your company. Decide what is best for your company. So this is an overall introduction about capital, everything that you need to know about equity capital, debt capital. If they give you a scenario question and tell you to identify, for this particular company, what do you think is the best type of capital? What are the types of capital? Is this company solvent? All of that they have asked in the past, they will ask again. Now you are able to answer because you have an overall view about capital. Though this session is a revision session, I particularly wanted to explain this part in detail because I understand that majority of students don't sometimes understand the crux or doesn't understand the meaning of how does this capital work. So that's why like an overall explanation was given so that you will never miss on this particular aspect. You will easily understand it. Thereby you will be able to answer the questions. With that, we are moving on to shares, right? To discuss about shares of companies. So what is a share? I have given you here. This is an exact good diagram to explain what a share is. Basically, what a share does is giving a part of the ownership. Like if you take a cake and cut it into pieces, taking a piece of that cake. Right? That is what we call as a share. So first one, what is a share? The interest of a person in the company, that interest being composed of rights and obligations which are defined in the Companies Act and by the memorandum and articles of association of the company. This definition was given in the case of Boland's Trustee versus Steele. So in the case of Boland's Trustee versus Steele only, they particularly gave this definition. So this is actually a part of the ownership. Right? This now when you take what this person takes here, this is the interest that this person has in the company. Interest in the company. Right? Now this interest can be in several folds. This interest is comprising of both rights. Interest is comprising of both rights as well as liabilities. Interest is comprising of both rights and liabilities. There are some rights that the shareholder will have in the company and some liabilities as well. So what are these rights? What are these liabilities can be described in the Companies Act. In the memorandum of a company, so nowadays there is no memorandum. This case is an old case. So in that case there was a memorandum. So now no memorandum. The rights and liabilities that are incurred by a shareholder will be defined in the Companies Act as well as the articles of association of the company. A share is an indivisible unit of capital. Now, why do we say indivisible unit? Now, when I invest money as a shareholder in a company to purchase shares, how much shares? Now, from let's take a building, which is the floor that I have invested in, no one knows. So, it's indivisible, right? But I have invested in the entire business. I have invested in the entire business. That's why we call it an indivisible unit of capital, expressing ownership relationship between the company and the shareholder. So it's showing the ownership relationship between the company and the shareholder, basically showing a ownership. Right? So a share is ownership. That's why because of the ownership only, a shareholder will have interest in the company. Because of the ownership only, shareholders will have an interest in the company. Nature of shares. How does shares work? A share in a company shall be movable property. Very, very important, right? Now, later on also in your life, if you are going to write, something like a last will, if you are a shareholder, the shares that you have in the particular company is considered as movable property, right? It's a movable type of property. Subject to the company's articles, a share in the company shall confer on the holder. So, what does the holder get? By buying a share of the company. The right to one vote on a poll at a meeting of the company on any resolution. By being a shareholder, you get a chance to vote unless it's a non-voting share. Later, we'll be discussing about the types of shares. Then I'll explain non-voting share. Usually, if you're a shareholder, you have one vote per share at a poll, right? At the poll means like a, sort of, let's say like an election. At a resolution where you have to vote, right? So if you have one share, you will get one vote. If you have 10 shares, you will get 10 votes. So it's one vote per share in a poll, right? The right to an equal share in the dividends paid by the company. So let's say company has, simple example, let's say company has 1,000 shares. Right, 1,000 shares. This time the company is having a distributable profit of 100,000. Distributable profit of 100,000. The distributable profit of 100,000 will be divided by the 1,000 shares. Meaning per share you will be paid 100 rupees. So if you have one share, you will get a dividend of 100 rupees. If you have two shares, you will get a dividend of 200 rupees. If you have five shares, you will get a dividend of 500 rupees. So therefore, you will have an equal right to a dividend on the share. The right to an equal share in the distribution of the surplus assets of the company on liquidation, right? Also, when the company is closing down, if there are any surplus assets after paying the loans, if there are any excess assets, the assets will be divided from the number of shares, and each shareholder will get the amount that they have invested in the company, or they will get. Now let's say again, let's say at the closing down of the company we have 100,000 worth assets, there are 1,000 shares, so per share 100 rupees. That means again, if you have 10 shares in the company, you will be paid 1,000 rupees. If you have 20 shares in the company, you will be paid 2,000 rupees out of the surplus capital, right? Now these terms are terms that you should be familiar with, terms like surplus capital and whatnot. Why? This is not the first time that you are hearing it. This is only a revision series. So if you don't know these nitty-gritties, it's going to be very difficult. The terminologies you need to know. So basically, with regard to a share, we talk about three rights. According to the Companies Act, there are three rights that are attached to a share. First one, the voting right. The voting right, you can't call it, it's not a right. I mean, you usually get one vote per share. Then you have a dividend, that the dividend payments. So if you are a shareholder, you should get a dividend proportionate to the shares that you have, and ability to take part in surplus capital. Third thing is the surplus capital. Third is the surplus capital. So these three are the main focal points when it comes to shares. Company may issue different classes of shares. There are different types of shares. The most common ones are ordinary shares, preference shares, voting shares, redeemable shares, deferred shares, right? So there are different types of shares. We are going to discuss the types of shares separately. A share is a company is transferable in the manner provided by the articles of that company, and such articles may limit or restrict the extent to which a share is transferable. Another very, very important point. You can transfer your shares to anyone at any time. Usually under the Companies Act, you can transfer your shares to anyone at any time. But there is a small thing that you have to take into consideration. Sometimes this power to transfer your shares to someone else might be controlled by the articles of association of the company, where it might say, okay, for a considerable period of time that you can't transfer your shares, or that even if you are transferring shares, the entire amount of shares can't be transferred. So there can be some restrictions placed in the articles of association, but usually a share is a movable property, a share is a transferable property. And because of that property, you get some voting rights, some dividend payments, and a surplus capital. You have a right to participate in the surplus capital, but these might vary based on the different types of shares. So this is an overall description about what are shares in a company. Then we are coming, that is what we discussed as the nature of the shares. Now, why I have to actually put this in this way in the slide is, if after you finish after we finish the revision up to the 10th unit, once you have finished studying, you can just go through these slides and check, okay, shares. What can I remember about the nature of the shares? What can I remember about the types of shares? What can I remember about the issue of shares? So the different aspects of the lesson is easily, what are the things you need to remember on the shares? I have put it into this sort of a slide so that it's easier for you to recall when you are studying, right? Let's get to the types of shares. So there are different types of shares. First type of share that we are going to discuss about is, now we are discussing the different types of shares. First type of share that we are going to discuss is ordinary shares. First one is ordinary shares. So what is the meaning of ordinary shares? We also call them voting shares, because when you take ordinary shares, these ordinary rights that comes through a share comes to all the ordinary shareholders. These three ordinary rights that we discussed above automatically comes to an ordinary shareholder, automatically comes to an ordinary shareholder. This is the basic form of shares, is the ordinary shares. Usually majority of companies only have ordinary shares. Ordinary shares vest the owner with one vote per share. I told you. So the voting right, usually if you are an ordinary shareholder, you will have one vote per share. entitlement to participate equally in the dividend. So you will have a dividend, aspect also. If you have ordinary shares, you have to be paid a dividend, but again, it doesn't come as a right. And if the company is bound, share in the proceeds of the company's assets after all the debts have been paid. So take part in the company's assets, all the debts after the debts have been paid. That is what we call as a surplus assets. From all the assets, once the debts are repaid, the remaining assets is called the surplus assets, right? So ordinary shareholder, as I told you, have the ordinary rights that are involved to a share. They have one vote per share. They have to be paid equal dividend like the other shareholders, and they have a right to take part or participate in the surplus capital. The risk is that holders of ordinary shares will be entitled to dividends only if the company makes a profit. So the risk of purchasing ordinary shares is you will be paid only if the company makes a profit. If the company does not make a profit, you will not be paid. If the company is not making a profit, of course, you will not be paid. That's the risk of investing in ordinary shares. On the other hand, what about now that's the risk, right? But all these rights are included. So in all of these types of shares, again, there are good things as well as bad things. Now the second type of share that we are going to discuss about is preference shares. Preference shares. So the next type of share that we are going to discuss in the company are called as the preference shares. Let's see what are the good things, bad things, rights, liabilities attached to preference shareholders. A company can issue shares having a ranking above ordinary shares in the specified aspect. So usually that's why we call it a preference share. We say that it usually ranks a little higher than the ordinary shareholders. Preference shareholders have a priority to a fixed dividend. So usually, ordinary shareholders are paid a dividend only if there is a distributable profit or if the company makes a profit. No, but when it comes to preference shareholders, usually they are entitled to a fixed dividend and return on capital and to return of capital in winding up. So when the company winds up, they have a right to a return of the capital as well, right? So they will have a right to a fixed dividend and return of capital, that is being a preference shareholder. These usually confer rights to preferential dividends which may be cumulative or non-cumulative. So usually before ordinary shareholders are paid a dividend, preference shareholders are paid a dividend. That's why it's called preference share. So before ordinary shareholders are paid a dividend, usually preference shareholders will be paid their dividend. So those are the good things. But when you take preference shares, usually there are no voting rights. So there are some, mishabits of it as well. But everything is like that. Let's get to the third type of share, deferred shares. So third type of share we are going to discuss is the deferred shares. Deferred shares, right? Let's see what happens with deferred shares. All right. So when it comes to deferred shares, under that I've given you, these shares are issued with limited rights. So usually when you take deferred shares, even limited rights than ordinary shares or preference shares. The fact that the deferred shares have no rights to dividends during a particular period does not mean they are not ordinary share capital. So the fact that the deferred shareholders have no rights to dividend, right? They also don't have a right to a dividend because only if made a profit that they will be paid a dividend. But that doesn't mean that they are ordinary shareholders either. This is a very different type of another share. Deferred shares are often created for commercial reasons to enable private investors to take capital growth instead of dividend income, especially if you're not really focused on a dividend, but you just want to expand your capital, right? In that situation, we usually issue deferred shares to such shareholders. They are generally issued to founders or directors of the company. So basically, you're not bothered to get a dividend. What you want is your money to be secured and expand within the company. That's why we usually issue deferred shares to either directors, owners, or founders of the company. These shares receive no rights to a company's remaining assets in the event of bankruptcy until all common and preferred shareholders have been paid. So once the company closes down in a situation of bankruptcy, first the preference shareholders will be paid, Then the ordinary shareholders will pay it. Only after that it will come to the deferred shareholders, because usually deferred shareholders are the founders and the directors of the company usually. But this can change, right? So three types of shares we have discussed: ordinary shares, preference shares, deferred shares. Fourth type, non-voting shares. Non-voting shares. So I told you the usual features, right? The usual features of a share only I have given you here, but these can be differed, or these can be different depending on the type of the share. Like I told you at the beginning, usually non-voting shares will not have voting rights, though usually shares will carry voting rights, especially non-voting shares don't carry any voting rights. Such shares are usually issued for the purposes of retaining control with the promoters. So usually, if you want to retain the control, if you're now voting, giving the ability to vote means you are giving a part of the control, right? Meaning of voting means you are giving a part of the control. So if you are issuing non-voting shares, or if you are issuing a share that does not have voting rights, meaning you are still keeping the control with you. You're still keeping the control with you, right? For example, there could be situations where the law prohibits foreign control of certain types of companies. So especially now, let's say you want to have foreign shareholders, but you don't want to give the management of the company, or you don't want to give the control of the company to foreigners. In that situation, you can issue non-voting shares. So they will invest in the company, but they will not have any voting rights in the decision, right? Another type of share is redeemable shares. This is the last type of share that we'll be discussing about. Redeemable share. So what happens in redeemable shares is are created on the understanding that they will be bought back by the company. So redeemable shares means company is going to redeem them back. Company is going to buy them back. That is what we call as redeemable shares. The redemption may be at the option of the company or the shareholder, or on a fixed date, or upon the occurrence of an event. So usually this redeeming of the shares by the company can happen in four situations. At the discretion of the company, when it can be at the discretion of the company, or it can be at the discretion of the shareholder, when the shareholder wants to give the shares back to the company, or it can be at a particular date. So in the redeemable share itself, the particular date will be mentioned: on this date that the shares will be redeemed by the company, or at the occurrence of a particular event. So if this situation comes, company will buy back your shares. So under those four situations, later on about redeemable shares, we are going to discuss again. The price at which the shares must be redeemed may also be specified either on the basis of a predetermined price or a formula. So not only the date that the company is going to buy back the shares or repurchase the shares, the price at that particular day, what will be the price that the shares will be bought back at, also have to be mentioned in the redeemable share. So the date as well as the price. So those are the main 5 types of shares that are discussed in your syllabus. So with that, we have completed types of shares as well. We discussed 5 types of shares: ordinary shares, preference shares, deferred shares, non-voting shares, and redeemable shares. Now, you have an overall good understanding of what are the main rights that are attached to a share, what is a share, the nature of shares, whereby the type of shares. Now, we are going to the last part to discuss about shares, about the issuance of shares, what is the process, or what are the requirements in the issuance of shares. Because as I told you, issuing shares can't be done overnight. You can't wake up in the morning and think that today evening we are going to issue some shares of the company. It doesn't happen that way. There is a process or a procedure. So what is the procedure of issuing shares? Because this again is a questionable area. They can tell you that a particular company wants to, issue shares. What is the procedure that they have to follow? So one by one, step by step, you should know the procedure. Company may raise capital through the issue of securities, that is shares and debentures, right? So debenture particularly can't be called as a part of equity capital, but that is also a part of debt capital. Debenture is also a part of debt capital, right? So anyway, company can raise finance by either equity capital or debt capital. No? So they can issue shares or debentures. Debentures are considered as loans obtained by a company, while the shares constitute the capital of the company. So as I told you before, when you take capital, right? Capital can be either debt capital or equity capital. No, shares are coming under equity capital. Debentures are coming under debt capital. Here, shares Debentures are coming under equity capital. Here debentures. Debentures are coming under equity capital. The prospectus includes any prospectus, notice, circular, advertisement or other invitation offering to the public for subscription or subscription to or purchase of any shares or debentures of a company. Now, a common feature for either share capital or debenture capital, that is equity capital or debt capital, is when the company, if the company is issuing it to the public. Basically, we are talking about public limited companies, right? If they are issuing shares to the public, they have to issue a document called prospectus, right? They have to issue a document called prospectus. Have to issue a document called prospectus, right? Prospectus, you think of the prospectus like something like this. Prospectus is like when you go to have, dinner at a restaurant, they give you a menu card. Prospectus is something like that. It might have the term prospectus on it, it might not have, but it will have all the details about the prices of different types of shares, the rates, different things about debentures, all of this will be mentioned in the prospectus. So, prospectus should be issued to the public before the issue of shares or debentures. A prospectus should be there. The Companies Act stipulates the specific requirements as to particulars in the prospectus. So, there are some basic things that should be mentioned in the prospectus. Accordingly, prospectus issued by or on behalf of a company or any person must contain information related to the nature of the business of the company. Prospectus should say what type of a company are we, right? So, these information are a must. Type of business activity, right? What is the type of business activity we do should be mentioned in the prospectus. Type of business activity should be mentioned. And the time frames, the nature of the shareholding, etc. So, different time frames, before what date can you buy it at what price, and different details about the shares, details of shares, rights attached to them. All of these have to be mentioned in the company's prospectus. It is illegal to issue applications or subscriptions without the prospectus, and every prospectus should be delivered to the registrar for registration. Very, very important other point, right? You cannot issue shares or debentures to the public without a prospectus. So, the first stage is the prospectus. Without the prospectus, you can't issue shares to the public, right? And you have to have proper information in the prospectus. You can't lie in the prospectus. So, you have to issue a prospectus, and every prospectus should be delivered to the registrar of companies as well. Prospectus should be given to the registrar as well for registration. After the prospectus is issued, now we are coming to the second stage. After the prospectus is issued, the company may place a tombstone notice. Tombstone notice. So, the second one. First one is the prospectus. Without a prospectus, you can't issue shares or debentures to the public. Prospectus is number one. After issuing the prospectus, so the prospectus should be registered by the registrar as well. After that, you have to issue the tombstone notice that the prospectus has been registered and that it is available on application. So, tombstone notice is where you let the public know, look here, we have a registered prospect. We have a registered prospectus, and when you go to apply for our shares and debentures, you can have a look at our prospectus. So, that is, you give notice to the people known as a tombstone notice. What is the meaning of this tombstone notice? Usually, when a person dies, we put the person, underground and put a tombstone there. So, the tombstone will mention the detail. You can't, go down and see who's inside the, particular, whatever, you can't go down and see who is inside the particular grave, right? So, next to the grave, you have a tombstone where the details will be mentioned. Same way, you have a tombstone notice when you issue when you get the registered prospectus, you issue a tombstone notice telling to the public, look here, we have a registered prospectus. Now, you can go and purchase shares and debentures. The tombstone notice shall not carry any invitations for subscription. Just because there's a tombstone notice does not mean that every person who comes and asks for the share or the debenture, company should be able to release it. No, there is no such requirement, right? But you have to have a tombstone notice to let the people know that either shares or debentures are available. Public limited company shall also comply with the listing rules of the Colombo Stock Exchange. So, especially if you are a public limited company, along with, the prospectus and the tombstone notice, you should also live by or you have to adhere to the CSE Stock Exchange rules or Colombo Stock Exchange rules. If a prospectus contains untrue statements, it may result in the company and the officers who are responsible for the issue of such prospectus incurring civil liabilities and criminal liabilities. You must not lie in the prospectus. It can affect both the company and any officers in default. Both civil and criminal liabilities will be incurred. Subject to the provisions of the Companies Act and the Companies Articles, the board of a company may issue such shares to such person as it considers appropriate. So on the prospectus, now people will come and ask. So purchases will happen after that, right? Purchases will happen after that. Board of directors, based on the Companies Act and the Articles of Association, board of directors can determine to whom they are going to issue the shares. Terms of issue approved by the board shall be consistent with the articles of the company, and to the extent that they are not so consistent, are invalid and no effect, right? So especially with the shares comes some terms of issue, right? So these terms of issue are drafted by the board of directors. It should be abiding by the Companies Act and the articles. If it does not abide by the articles, terms of issue will be invalid or inconsistent. They are deemed to form part of the articles because terms of issue should be a part of the articles itself. Within 20 working days, these numbers are very important. Within 20 working days of the issue of any shares under this section. So now purchasers will come in, then you issue the shares. After that, you issue the shares. So what are the things you have to do within the 20-day range? Within 20-day range of the issue of shares, what must you do? The company shall give notice to the registrar in the prescribed form the number of shares issued. Within 20 days of issuing of the share, company should inform the registrar how many shares were issued, the amount of the consideration for which the shares have been issued, or its value as determined by the board. How much did the company get by issuing these shares, right? What is the consideration? Now, let's say each share is worth 10 rupees. Let's say we issue 1,000 shares. That means 10,000 is the consideration, right? So that amount have to be informed. And the amount the company stated capital following the issue of the shares. Now, sometimes all 1,000 shares people not purchase. No. So amount that people purchase accordingly. What is our stated capital now? What is our share capital now? Have to be mentioned within 20 days of the issuance of the shares. The company shall deliver to the registrar a copy of any terms of issue. If there are any terms of issue, that also should be given to the registrar. The share is deemed to be issued when the name of the holder is entered in the share register, right? So after that, the companies will maintain a share register. After that, companies will maintain a share register. Maintain share register. So the details of the company will maintain the share register. Once the details of the shareholder is included in the share register, then only we say that particularly shares have been issued to this person and this person is now a shareholder. The issue by a company of shares which imposes a liability to the company on the holder shall be invalid and of no effect until such time as the person to whom it is issued has consented in writing to become the holder of the share. Now, the very important point. So, once you issue the shares, you can't incur further liabilities on the shareholder. The shareholder will only be bound by the amount that the shareholder have invested. While in companies, there is an aspect called limited liability. Liability is limited to the amount the shareholder invested in the company. Company can't put any more extra liabilities on the shareholder unless the shareholder accepts such liabilities in writing. Unless the shareholder accepts such liabilities in writing, company can't put any new liabilities on the shareholder. So this is the procedure of the issuing of shares. This is the procedure of the issuing of shares. So issue of shares also we have completed thereby. First, company prospectus should be issued. Company prospectus should be given to the registrar also for registration. Then once you get the registered prospectus, you have to put the tombstone notice telling the subscribers, look here, we have issued the applications to purchase shares and debentures under the company under the registered prospectus. Then people will come and ask for the purchases. Then you have to issue the shares and the debentures. So once, if you're talking about shares, right, within 20 days of issuing of the shares, you have to inform the registrar about how many shares were issued, how much was the consideration of the issued shares, and what is the stated capital of the company now. Those shareholders have to be informed. And once the name of the shareholder is included in the share register, that person remains to be a shareholder. That's the procedure of issuing shares in a company. So that also we have discussed. So mainly you have know all the aspects of a share, starting from what is a share, nature of the share, type of the share, and ending in the issues of shares. So with regard to shares, there is one small other aspect that you need to know, known as the preemptive rights to new issues, known as the preemptive rights to new issues. So meaning, right, I'll simply explain it to you before we get down to the note. It is something like this. Now let's say there are 1,000 shares in a company. Let's say there are 1,000 shares in a company. Let's say there are 1,000 shares in a company. I own 100 of the 1,000 shares. I own 100 of the, or we'll take it in hundreds, then it's easier to calculate the percentages. No? So there are 100 shares in the company. As of now, there are 100 shares. I own 10 shares of the company, meaning my shareholder percentage, is 10%. This is my power over the company. My power over the company is 10%. In the decision making, I can take part in 10% of the decision making. Now suddenly, company decides to issue 100 more. Company decides to issue 100 more shares, making our share capacity 200. Now outside people buy this remaining 100, buy the 100 shares. I still have 10 shares. My 10 shares will remain. But now the total number of shares is 200. Total number of shares is 200. So if you calculate the percentage here, you will understand that it is 5%. Now earlier, I having the same number of shares, I had 10% of the control of the company. Now I didn't do anything wrong. My 10 shares are still there, but company have issued new shares, which the company can do. Thereby what has happened is my power has decreased. My power has decreased. So usually shareholders don't like this. Why? Share means an ownership. I have an interest in the company. Now my interest in the company have been reduced. So because I don't like that, only comes this topic called the preemptive rights. Right? If I am an already existent shareholder, I should be given the chance first to purchase out of these shares to maintain my power. Example, now 100 new shares are issued. Now total shares is 200. Now these 100 shares should be first issued to me, asking me whether I am willing to buy another 10 shares of this company, only to the percentage that I already own the shares, right? Earlier I had 10 shares out of 100. Now again they are issuing a new 100. They'll ask me out of this 100 also, do you want to buy 10 shares? Because if I buy this, if I buy another 10 shares, let's say of this, I buy 10 shares. Now my total shares have come to 20 and total number of shares in the company is 200. Again, I am at my 10% shareholding. So, again, I am at my 10% shareholding, which is equal to my previous shareholding, Alright. So, usually companies will buy this, right? Shareholders will buy these additional shares because I can maintain my shareholding, and then my shareholding power is not diluted, right? So for that purpose, usually when company can issue shares, no problem, but it's first given to the already existent shareholders in their shareholding capacity. If they want to buy, the offer should be open for a reasonable period of time. If the shareholder don't want to buy, can't help it, you issue it to outsiders. The particular shareholder shareholding power will come down. Decision-making power will come down. But we give the right first to the shareholders to maintain their power over the company. We give the shares first to the shareholders to maintain their power over the company. That is what we call as a preemptive right. Subject to the company's articles, where a company issues shares which rank equally with the above existing shares in relation to voting or distribution rights, those shares shall be offered to the holders of existing shares. Holders who already have shares, existing shares, in a manner which would, if the offer was accepted, maintain the relative voting right. We are maintaining the relevant voting rights. You can see here also 10%, here also 10%. I am maintaining my voting right. and distribution rights of those shareholders. Such offer shall remain open for an such offer shall remain open for acceptance for a reasonable period of time. You can't keep it open forevermore. So for a reasonable period of time, to the already existing shareholders, we'll say we have issued new 100 shares. You already have 10 shares out of 100 shares, so we can give you to purchase another 10 shares. Do you want to purchase? So the first option is given to the already existing shareholders. First option given to the already existing shareholders. That is what we call as statutory preemption rights or preemptive rights in the new issues of shares. So with that, we have completely covered the shareholding area, where we have started with what is capital, what are the two types of capital, and we went ahead with equity capital mainly, where we discussed about the shares, what is a share, what are the nature of shares, types of shares, issue of shares. We discussed about 5 types of shares, and we discussed the procedure of issuing of shares, and where we ended by discussing the statutory preemptive rights, or giving the first right over the newly issued shares to the already existing shareholder to maintain their voting and subscription rights. Alright, so with that, we have completed the share issuing and the types of share part. We have to discuss about dividends as well as how debt capital comes into play in the next session. So up until I see you at the next session, keep on studying.